Hey friends, Lucian here with the Bullish Bears team, making this video on the difference between a limit order and a market order. In the back office of Thinkorswim right now. This is the Thinkorswim platform. It doesn't really matter what platform that you use. Just going to try and make this very simple for you. A market order will basically allow you to put an order in or sell an order at the current market price. So if the market price, let's say I'm just taking, for instance, this stock HTGM, currently right now, if you look down over here, you'll see this right here is level one. So you'll see on the left is the bid price, what people are willing to buy. And open is actually ask on Thinkorswim. It's very weird, but this is what the price that people are looking to sell it at. Down here, you'll see level two, so you'll see number of buyers versus the number of sellers, and you'll see the current price is 180. So if you sent an order out to the market, it would buy it at 180 or whatever the current price is. A limit order allows you the ability to buy at a specific price or sell at a specific price and nothing higher or nothing lower. So meaning right now you'll see that people have limit orders to buy at 179 right now. So you'll see 4,800. So you just add two zeros on with level two. You'll see there are 4,800 shares looking to be purchased at 179. The current price is 180, which means these people at this point right now are not willing to pay more than 179 for their order. So they have a limit order that the most that they're looking to pay is 179. So they're just gonna, obviously it's always the battle between the buyers and the sellers. Over here, you'll see that there's 3,600 shares looking to be sold at 180, which means they're not looking to sell at this point lower than 180. So now you have a tug of war in who is going to budge first. So limit orders are basically limits to buy, limits to sell for a specific price, and until one side budges, it's just that continuation back and forth of price action. Again, market order right now, if you send an order to the market, it goes at 179. So the risky thing that happens is right now, obviously, I'm making this video. It's kind of a little bit slower. It's during lunchtime hours. So sometimes price action is really just kind of dead during this time. Kind of most of the time, it kind of trades sideways. But if when the market's really volatile, if you put a market order out there, you got to be very careful because price can move so quickly, and a lot of times there'll be big bid ask spreads that are really kind of wide apart, 10, 15, even more, 20 cents. You want to be careful because if you send an order out to market, a lot of times you'll be overpaying, and or same thing, if you're selling to the market, you might not get the best price. So the most common way to trade is through limit orders, unless you want to get out of a position, let's say really quickly. Let's say you're in a position, the stock's falling really quickly and you want to get out, then maybe send it to a market. Or again, I usually use, and most traders use limit orders to protect themselves. And it's just because price could be very volatile when you're trading, and it can go really quickly up or down. So again, sending an order to the market buys at the current price, whatever it is. And obviously during the market, when it's open, price goes up and down pretty quickly. So that's really the difference. Buying at market is the current price, and limit orders are really the most common for most traders. You'll start to see when you look at level two, a lot of times it can be manipulated, but you can see, kind of get an idea of what the price, where people are looking to buy and where people are looking to sell, just by adding on the two zeros to the numbers that you see down here. And then when it gets to level two or level one up here, you'll see what the current bid and ask are. Again, buyers are the bid side of things. Sellers are the ask side, or on Thinkorswim it says open. Not sure why, but you'll see ask down here. Just show you a couple more, just give you a couple more examples here. Right here, if you were to send an order out to market, you see how quickly that just changed? It went from 370 down to 365, right up to 368. So that's what happens with market orders. The price can change very quickly, and when you send it, that split second it can change up or down pretty quickly, and that's why it's important to protect yourself with limit orders. Just seeing what price exactly you want to get in on, and really protect yourself. So if you put an order in at 365, it won't fill until the price drops down to 365. So you won't end up paying 369 unless you move or change your bid. So that's really kind of the basics of it. We'll look at like another one here just for an example. Let's see if I can get one that has, so you can see here, some of these have different bid-ask spreads. So right now, if you put an order out to market, it goes to 370, and right now the most people are willing to pay is a 365. So you could already be down 5 cents right off the bat. So a lot of stocks do trade with a 5-cent increment. And those are ones, again, it's a matter of your preference to trade. I personally don't like to trade those very much. I like really kind of tight bid-ask spreads, unless a stock is really kind of really running on news and I pick my entry, and that thing's going to go up. A lot of times a stock will have a bigger bid-ask spread, and it's a runner, a low float stock with news. Once it goes up, it could, change really rapidly. But it's always really, again, always important to protect yourself, and that's where I don't really suggest using market orders unless you're trying to get out of a position really quickly, or potentially if the stock is running, it has a tight bid-ask spread, and you put a market order in that way. Again, I'm just not really a huge fan of it. So hopefully that helped you. If that didn't help you and you want more of a breakdown, you can go to a website called Investopedia. We just really like Investopedia, and you can come up here if you want to look more of the technical definitions or stuff like that. You can type in limit order up here in the search bar, and it'll show you here a limit order, what's the difference between a stop and a limit order. You can look over here and type in market order, and there you go, right here, market order. So if you want to see more of how it breaks down, just go over to Investopedia, or you can just go into Google and type in limit order or market order. But I think I just did a fairly good breakdown and just simplifying it. A limit order is just the maximum price that you're looking to buy, or the minimum price that you're really looking to sell at. And that's really it, to protect your entries on getting in, or to protect also your gains or maximize your gains on the way out of a position. And selling to the market would means you're really you want to get out of your position. Or if you do want to buy into the market, that means you just really want to get in that position very quickly. So if you're not looking to get in and out of a position really quickly, then you definitely want to do limit orders. So hopefully this video helped you.